Hello and welcome into the KE Report. Chad and Corey here as your host, and today we're talking with our friend and colleague Nick Hodge. Nick is the co-owner of Digest Publishing and editor of Foundational Profits and Underground Alpha. And Nick, it's always great to have you on the show to get into some of the drivers in the macro environment, but also, of course, in the commodities and resource space. While there are a lot of different macro developments, many of them are still kind of the same tone as what we've looked at the last few times with the Fed potentially cutting and a lot of people looking at 2026. Will there be a series of cuts? People are looking at inflation and jobs. The government's back open again. So a lot of that is kind of status quo. But what has not been status quo has been the pricing reaction in some of the metals, in particular the precious metals. We see gold continuing to hover near all-time highs, very strong position for the producers and developers and the economics on projects. And then silver's really been the runaway train since we've talked last. Not only were you right about the fact that we were just seeing a correction in October when we chatted last, but it's turned into an all-out rally. Just love to get you to weigh in, I guess, coming out of the gates on the move that we've seen in silver and the silver equities.
Awesome to be with you guys. Missed the interview last month, but saw you guys in New Orleans, so that was great. Silver's at an all-time high, or recently hit an all-time high, right? Higher than the Hunt brothers squeeze, higher than the fallout from the global financial crisis, and looking pretty good there at $58 an ounce. I mean, has been incredibly strong, right? Is now quietly or maybe not so quietly outpacing gold, and you've seen a compression in that gold to silver ratio, and some of the stocks are being rewarded and able to raise a lot of money, right? I see companies like Arizona Sonoran and Vizsla Silver announcing really large raises and only taking sort of a day or two to digest that dilution before they're back up to all-time highs. Full disclosure, I own both of those stocks, but I sent an alert out to readers 2 weeks ago when Vizsla announced their raise, and it pulled back to $4 US on the New York Stock Exchange, and was saying y'all should buy this up, right? And sure enough, a week and a half later, it's back over $5. So really strong sentiment and investor appreciation of the silver sector. And I'd be remiss if I didn't mention the moon, because I was pretty critical of the moon guys over the past 5 years, and I still don't know if $58 is a lunar landing, but silver's definitely looking strong.
Nick, how much do these higher silver prices bring on other silver companies onto your radar? Whether they have a resource or just an exploration play, does it make these lower quality companies or earlier stage companies more attractive to you?
Silver's sort of difficult, as you guys know, right? Because there's not a lot of pure plays. It's typically produced as a byproduct, and I've never really sort of had that silver bug itch to scratch. So I don't go deep on some of these pure play silver companies. But as a general investment theme, it definitely pulls me closer to silver. And I've explained to you guys how I do things over the years. So some of these companies that have been sort of not on people's radar, or that are just now doing drill campaigns, are definitely coming into the fore. Like, I've been talking to you guys over the past year or so about Kingsman Resources, which we raised money for at like 15 and 25 cents. This morning, that's a $2 stock, right? I actually just announced a new discovery this morning of something like 2 meters of 900 grams silver equivalent. So people are getting attracted to these stories, and I love to see success, and I love to see a good response to the drill bit. So yeah, it brings me closer to those companies. It makes me more interested in them, and the way I finance those companies. And I'm looking forward now to 2026 and the expiry dates of warrants. I find myself checking on more and more, because that's sort of the next way that I'm going to deploy capital into that space is taking warrants down. And I think we've got 40 or 45 cent warrants in that. It's a $2 stock, right? So, and then on the bigger side, I told you guys last month about, or in late October, about SLVR, which is sort of a hybrid physical silver miner ETF. And yeah, that's been great as well. So, and then it brings in the generalists, of course, right? Like, I was catching up on emails from being out a couple of days for Thanksgiving, reading my Bloomberg energy newsletters, for example. And one of their charts of the day last week was the gold silver ratio. Like, tell me the last time you saw Bloomberg writing about the gold silver ratio, right? So I think the generalists are getting more interested, and then the media is starting to respond to these all-time highs because they're getting hard to ignore. The last time we were talking in October, I was saying that was amid sort of a gold and silver correction. And I was saying that I'd seen more press about the correction, right? Silver coming back to earth, gold coming back to earth, than I did about the ascension over the past 12 to 18 months. And now it seems like that's starting to change a little bit as well, where we're getting some more positive coverage in the wider and broader mainstream media. So that's all wonderful to see.
Yeah, Nick, you nailed it there. We have not seen that much media coverage on the positive side, but if there's a correction, that's when the knives come out. But to the point you made back in October, it was just going to be a short-term correction. I found it strange throughout the month of October how much silver and gold juniors and some of the mid tiers pulled back, considering where metals prices were relative to Q3. Love you to get you to weigh in on what you think as far as how the market has priced in the expectations for Q4 earnings, because you brought up generalists there and them starting to pay attention to the sector because the prices are too big to ignore. I don't think that the marketplace is properly factoring in, but I'd love to get your thoughts on it. Do you think that these Q4 earnings are properly priced into the producers as they stand today?
Well, let me first address the oscillation you were talking about in October. I think that, from a macro level, we were looking at a dollar that was strengthening, heading back towards 100 on the DXY, and that gives investors and generalists pause in terms of commodities and precious metals when the dollar is strengthening. We had seen sort of the rate cut expectations starting to go down as well, from a near 100% certainty of a December rate cut to down to sort of 50-50 odds we hit in November. So that was getting priced in. I think that's what caused some of that correction as well. And then, lo and behold, here we are a month later, and we're back up to sort of a 90% chance of a rate cut, and the dollar knocked on 100 on the DXY, but then turned right around and is softening. So you get those tailwinds again for the precious metals and commodity space. And again, last time we talked in October, I was pointing to the upcoming earnings. I think Newmont was a week out from reporting the last time we spoke, and I was saying that those earnings reports would start to attract generalist investors. And I think that happened, and it sort of flew under the radar a little bit. Since we spoke then, Barrick, Alamos, Kinross, they've all hit new highs, right? After their earnings report, GDX is right back to where it was at highs. And so some didn't, right? Like Newmont didn't quite get to all-time highs, but we've seen exactly what you're asking about. Like, I know you guys have seen the news about, Barrick proposing to spin out its North American and Dominican assets into a new company. And that has been super well received by the market. If you look at the ticker B on the New York Stock Exchange, for example. And so again, pointing back to the mainstream media and the generalists, I was getting, news updates and mainstream newsletters in my inbox that were all about this Barrick deal, right? And so eyes are definitely on the sector. And sort of a broken record as I tend to be, oil still can't get out of bed, right? I mean, I think it's still at $59 or $60 and is not in danger of breaking out of its downward trend line anytime soon. And so those cost inputs to these major miners are still down and to the right, while the price of the underlying commodities and precious metals they produce are up and to the right. And you can see a little preview of that in, recently reported royalty companies like Royal Gold and Empress, for example, which I follow and am a shareholder in. Royal Gold reported record revenues. Empress just reported record 9-month revenues. So those high prices are flowing down, especially into these streamers and royalty companies. They get to benefit from the higher price. Absolutely.
So following up, I guess, on Chad's question, more valuation of the underlying equities. Is the whole sector undervalued? Are there certain classifications of stocks that you find being undervalued in the gold and silver space?
I still think that developers, brownfields haven't got the bid that they deserve, and I'll elaborate on that a little bit in terms of the larger stocks that I was just talking about. For the past couple of years, we've seen a mandate from investors and boards in these large producing companies to increase dividends or buy back stock, as opposed to go out and spend money on buying growth. And I think that's what has to happen next. I think that investors are going to start demanding, revenue and production growth from these companies, the majors, that they're not going to be able to generate organically. And I think that translates into more acquisitions into these well-developed and emerging developers and brownfields developers in the precious metals space. So if you're asking me to sort of pick one sector of the precious metals companies, those are companies I like, either past feasibility study, right, gearing up to produce, or companies that are breaking ground and have recently started producing. I mean, you sort of see that being reflected in companies like Contango and Artemis, for example. I mean, the market's going to have to pay an even higher premium for those once the money starts coming from the majors. And I know we're talking about silver and gold, but you just sort of had almost a bidding war for tech, right? With Anglo and BHP coming back for a second bite at the apple and getting turned away again. And so, yeah, I think that's just the tip of the iceberg. And I'd be looking at those developers and brownfield companies.
Well, Nick, just speaking of the brownfield companies, the developers, it's crazy to me that we're at $4,200 gold and $58 silver, and yet a lot of the takeovers we've seen for gold companies have been at, let's say, between $50 to $100 an ounce in the ground. I mean, the margins these producers are making, the senior producers or the larger mid tiers, are between 1,500 to 2,000, and they're going up by even more than that, $500 just in Q4, as we just discussed. So their margins are expanding, even though the takeover premiums aren't anywhere close to what they're paying in the ground for that. So same thing with silver. Silver is getting on the best development projects $4 to $5 an ounce in the ground. On a lot of them, $1 or $2 or $3 an ounce in the ground. Silver's at $58. Why aren't the brownfields companies getting a better valuation just based on their economics, but also better M&A deals?
I don't have all the answers to questions like that. One is they get overlooked by the market. They don't have the splashy production profiles, or people just haven't done the work essentially. The other thing I would point to is sort of a beaten dog scenario and the Lassonde curve. So you got some of these guys that are trapped between, PE, not trapped, but in between PEAs and feasibility studies, and in that downward part of the Lassonde curve, it's going to take some of these majors coming and offering higher multiples, as you say, higher in situ valuations for these companies, for investors to finally get it. If you do the work and you hold tight and some of these companies that are destined to be acquisition targets, I think you'll be fruitful over the next 12 to 18 months. I've talked to you guys almost incessantly about Perpetua Resources. There's a sort of a little sister company to that, although they're not biologically related, in Revival Gold, that's got a couple of brownfield assets, one in Idaho and one in Utah, and they're doing great work. Proven that they've got two past producing assets, right? Bear Track Arnett, it was the former largest producer in Idaho, and Mercer in Utah, where they're actively drilling now and putting out good results, showing that they can improve the metallurgy. And yeah, they're at 52-week highs at 75 cents, but like you say, on a PNAV multiple, they're not reflecting what I and likely others inside the space think they should be valued at, and they will be. So the last time we were speaking, I was telling you a story about how, you couldn't give Perpetua away at $3 and $4 a share. And now you got folks, including the Department of Defense and big Wall Street bankers, fighting over it at $40 a share. You'll see that in companies like Revival as well.
Now, on this whole valuation front, again, especially for these takeover candidates, I still believe value is really going to be determined by these majors or somebody acquiring these projects, because unless these guys go out and build it and go through that long time frame of financing and building the asset, which they can create a lot of value of, yes, we can think that they should be valued higher, but is there anybody outside of the majors or mid tiers that could actually set that value higher?
I mean, again, there's funds that are being developed. There's, private companies like Appian Capital and things like that. And we've seen, money in the Middle East. We just had a visit from, a crown prince from Saudi Arabia who was inking deals with the US on nuclear and critical metals. And so you could see some of that sovereign wealth and some of those, private funds come into the space and start deploying capital. That would be the easy option to point to.
Nick, just as a follow-up to that, we've also seen crypto money coming into the royalty companies. You mentioned the strength of the royalty companies. We've seen Tether, the stablecoin company, Tether Investments, which is their personal investing side of it. They've been placing money into about 5 or 6 different royalty companies now. Could we see crypto money come in and give some of these companies a bid if the internal leaders in the space aren't going to do it?
Yeah, I mentioned the New Orleans investment conference earlier, and I was on the mining share panel there. And one of the answers I gave about external capital that could come in was exactly that. And I was pointing to a speech I gave some 6, 7, 8 years ago there, where I was calling for crypto soldiers to be training for the gold army. And lo and behold, that's precisely what we've seen in Tether. I don't know if you've read some of the deep dive articles on the Financial Times or things like that. They've formed internal funds in Tether to go out and make additional acquisitions and deploy capital. And I would say it's not just these big stable coins with large treasuries, it's the investors themselves, right? I mean, we just saw Bitcoin go down from, $120,000 to $79,000 in very short order. I'd have to assume that some of that money went into gold and silver as those sort of other investments, I don't want to say come on their radar, but have the momentum, right? Like, and I've told you guys this before, like these meme stock guys, these crypto stock guys, they're momentum chasers, right? And they go into what's working. And when Bitcoin and Ethereum goes down like it was, and we see drawdowns there, I think some of that money is definitely going into the precious metal side of things. Yeah.
Hey, precious metals have had the momentum on their side. They've outperformed, I think, every other sector so far this year, and they're arguably going to end the strongest this year. Let's move to another sector that wasn't getting a whole lot of love, but has come back onto some people's radar, and that's the lithium sector. Boy, oh boy, people had written off lithium, it seemed like, but now that the price has rebounded, we're also seeing the lithium companies, which are a generally smaller group of companies, they have rebounded nicely. What are you seeing in the lithium space here, Nick?
Yeah, you asked me last time we spoke to name a sector that was completely out of favor that folks should be looking at, and I pointed to lithium. There's a couple of things going on there. You mentioned the price of lithium carbonate is going back up, bottomed out over the summer at some, I don't know, $8,000, $9,000 per ton of lithium carbonate, and has gone back up now closer to $13,000 a ton. So, that's a healthy move. That's sort of a 50, 60% increase in the underlying asset price. You've had really good sales out of China. I don't know if you guys follow any of that, but they had an incentive that's expiring at the end of the year with people, which forced people to rush in and buy cars. You see companies like BYD posting record sales, and I think that's one thing that's driving it. And then the other thing is good results, right? So there was a while there where good results weren't getting any attention. But if you look at companies like Q2 Metals, which we financed a couple of times, once at 25 cents and once at 12 and a half cents, that's now become a 10 bagger just in pretty short order here over the past couple of weeks. And they put out a whole just today, in fact, as we speak, December 3rd, 2025, the year of our Lord, that was the best hard rock spodumene drill intercept ever on our planet, right? And so those are a lot of superlatives there, nearly 500 meters of, I think, 1.6 something percent spodumene. And so, that company was up to new highs today and is seemingly attracting investors again. So, to point to the old Rick Ruleism, you're either a contrarian or a victim. And again, pointing back to last month at the conference, I also pointed to lithium as something you should be checking out for 2026, precisely just because it was out of favor. I mean, sometimes it's as easy as that, right? The same as trees don't go to the sky. These commodities don't go to zero either. I mean, there's still a very real place for them in the world. There's still a lot of EV sales, as I was just explaining. And so the companies are going to need that commodity, those inputs to build these batteries going forward. And sort of like we've seen in other spaces that we're now enjoying success in, like gold and silver, which we just discussed, and uranium to some respects. Prices down where they were can't beget the development that's needed to sustain that industry going forward. And so sometimes it's only a matter of time until the underlying commodity price course corrects. And I think that's what you're seeing in lithium and lithium stocks now.
Well, Nick, I think those are such cogent points. And every single part of the commodities is cyclical in nature. It tends to have one side of the pendulum at an extreme and then the other side. What made you decide, other than the fact that it was way oversold, to start positioning so aggressively in lithium when a lot of people felt like, hey, the sector maybe had got overcrowded. There was so many new entrants. There was a lot of new production that was brought online. But you saw the opportunity when things were depressed. Was it simply that the cure for low prices is low prices, or was there some other macro factors driving it?
I mean, there's a couple of things there. So let me not take all the credit. That 10 bagger I mentioned in Q2 Metals was a financing from 2021, right? So that was sort of positioning in the last boom cycle. And I've just held on to that position, right? And still own it because I knew it was going to come back. Nonetheless, we did finance Q2 Metals again in 2024, last year in August at 25 cents. And that was at the bottom. So that's just having the chutzpah and the conviction to stick with the trade and buy at the bottom, right? Hold your nose and pick that bottom, as it were. And that's just being a contrarian. I could point to other companies that aren't even public yet, like, Cisco's gonna spin out some lithium assets, and my partner Gerardo and I are positioned pretty well in that private company that you'll see IPO here in the new year, and turn and add a new branch to the Cisco family that's a critical metals branch, and they're already taking some of those projects and vending them out to other companies. You'll see even some folks that are close to Cisco going on boards of other companies like Lion Rock, for example, and that's actually a good one to bring up. We financed Lion Rock at 20 cents just in September of this year, and then that's a 45-cent stock. So again, positioning in these companies ahead of drill campaigns. And just to elaborate on that, I'm not sure if I've mentioned that company to you before or not, Lion Rock Resources. That's drilling right now on a hard rock lithium slash high grade gold asset in South Dakota that's been in private hands for over a century and has some of the highest grade surface samples in the lithium space. I'm talking like 4 or 5% lithium, right? As well as, gold hits something like 12 to 18 grams per ton. So drills are turning on that right now. If you look up the news history of companies like Lion Rock, you'll see that they've added new board members that have ties to a Cisco recently. And so I'm not sure if I answered your question there, but we've continued to position in these lithium names over the past year and a half, as I just explained, with placements in Q2 Metals and Lion Rock Resources, just knowing that the price at $10,000 a ton of lithium carbonate was too low. And maybe to front run your next question about direct lithium extraction, I don't sort of take that into consideration in the present day, right? When I'm financing these companies, I'm not worrying about how supply demand dynamics could change in 2026, 2027, 2028, et cetera. I'm looking at the here and now in terms of two things. What major auto manufacturers are doing, like they're still partnering and helping develop hard rock lithium assets. And so they like that stability. They like that known metallurgy and that known process to go from hard rock spodumene with clean crystals into a battery grade concentrate. They don't really like black box technologies and things that haven't been proven and borne out for years. And that's just something I've learned over my now 2 decades in the space is, black box technologies can be exciting and they can deliver returns. But when it comes to getting them out of that black box, that sometimes presents a challenge. And then when it comes to attracting strategics that think in decades and not quarters, it's tough to get them to write big checks because the process hasn't been proven. And so if I can finance companies that are drilling now in the here and now on assets that I think can return favorable results, i.e., the 400 and some meters of 1.6% that I mentioned with Q2, and those 5% grab samples with a known pegmatite underneath them that Lion Rock has drills in now, then that's where I go because I don't need to hold stocks forever. And if direct lithium extraction is proven up over the next 2 to 5 years, there's no reason that I can't pivot. I think that's one thing that challenges humans in general and resource investors in particular is being able to change their minds, right? Whether they're hardcore gold bugs or whatever it is, you just need to be able to say when you're wrong and pivot. And I have no problem doing that if direct lithium extraction comes on in a very big way. But as of right now, I'm sitting on a 10 bagger in Q2, and I don't see direct lithium extraction, impeding those returns in any way.
Nick, I find it so interesting. You've come on the show very consistently, and you keep bringing up these companies you financed at really low prices, really before they had anything, sometimes before their even initial drill campaign. I think we've all been in some of these stocks that we got in early, and some might have gone up, and some might have done absolutely nothing. What's been your secret sauce to finding these plays that, quite frankly, the rest of the market is ignoring because they're so small, but you're seeing value or at least opportunity in them? Obviously, a bull market helps when metals prices go higher. So, how are you doing it?
Yeah, let me first tell you what the track record is because you wouldn't believe me unless I was looking right at the spreadsheet. So let me tell you, right now we've got 46 open private placements that we've done stemming back to 2017, 46 of them. The average return is 315%. That's the average return. I think something like 8 of the last 13 we've done are up more than triple digits. So that's the track record. And we've been able to attract members as a result of that. This is a service called Private Placement Intel that folks would know. Like there's videos of Doug Casey on YouTube saying that he sources private placements from me. I just did a pretty big marketing campaign with Rick Rule where we talked about deals that we've done together, including companies like Kincora Copper and Headwater Gold, both of which have been, doubles, triples, or better for us in the past couple of years. And that's really the answer. It's the network and the people, right? And the work ethic. So, not to pound my own chest too hard, but I've been at it nearly 20 years. I try to do right for my subscribers. I'm not a cheap paper guy. I don't take options. I'm not, selling paper down people's throats. I'm writing about what I own and what I'm buying, and the same for my partner Gerardo. And then in that way, success begets success. I'm sure you guys have heard Rick talk about how he invests, and given, I could recite his speeches. I've heard him so much over the past 15 years, right? The serially successful people continue to be serially successful. The Ross Beatties, the Bob Quartermains, the Lundins. I'm sure you guys have heard that speech, and not that I'm anywhere close to that level, but that's the answer to your question: is running in circles and being honest and telling the truth and doing right for your subscribers and those companies that you're helping to finance. So, and just to add on to that, like we're not paper flippers, we're not warrant collectors. To take a line from Robert Dickinson from the Hunter Dickinson Group, who's a legend in Canada and a member of the Canadian Mining Hall of Fame. When we do these deals, we're looking to get in a boat and row somewhere together. And everyone's got to be in the boat and everyone's got to be rowing in the same direction. And you don't find that in a lot of TSXV companies. It's a lot of, and you guys know this, lifestyle companies, paper flippers, warrant collectors, and they're not trying to mine anything but shareholders' pockets. We avoid those deals. We avoid those people, and we only do deals with people who are trying to get from one shore to the other with shareholders in the boat. And you've heard me mention Jeff Phillips a lot, and I know you guys have done some interviews with him. That's his whole deal, and that's what he's educated me about over the past 2 decades. Is it's about structure and people, and one reflects the other, right? Good people have good share structures, and good share structures are typically conducted by good people. And to elaborate on what I mean by that, it's that cheap paper game. It's that not having shares registered in your own name. So you've got insider selling because they're not fully reporting and things like that. So that's how we do our due diligence. And those are the circles we run in. And I just laid out the track record for you there. It's been pretty darn good.
Well, Nick, very well stated. And I think for people listening in, all the more reason to go check out what Nick and his partner Gerardo are doing over at Digest Publishing. So definitely click on the link below in the show notes. But before we wrap up, Nick, because you guys are circling around the quality teams, the quality deals, looking for what could be next, I feel like I'd be remiss if we didn't at least touch on copper, because copper closed the month of November at all-time highs. COPEX and the copper producers closed the month of November at all-time highs. Copper is getting used to being a $5 a pound level, and it's getting comfortable at that price, and the market is, but it still doesn't seem like it's enough to really incentivize a ton of new production. But you're looking at some earlier stage companies. I guess just give us the lay of the land on what you're seeing on the copper macro, but also some of the companies on your radar.
Yeah, I mean, we've been having these talks about critical metals and we see what the federal government is doing. There's no metal more critical for the grid build out and data centers and electric vehicles than copper. That's pretty obvious. We've seen the forecast structural deficits from Goldman and Morgan Stanley and others that are expected to materialize in the coming years. And so that's the fundamental macro backdrop. Getting a little bit closer and drilling a bit down further on that, you've got this bifurcation of North American and Eastern markets because of the tariff situation that Trump induced back in the summer in July when he announced the tariffs and then backed off, and that led to a lot of copper coming into North America and leaving the eastern part of the world with a shortage that's now led to, those the TC costs that we see going negative. And so that's the underlying macro backdrop. And then other stuff that you guys know is, landslides at Grasberg, Codelco sort of cutting production forecasts. And I was telling you guys in late this summer that after Ivanhoe had some problems with some seismic activity and flooding that I was buying that stock. And look, that's another serially successful guy that I didn't mention in my last answer, Robert Friedland. If you look again, just today, that company had news, and it actually wasn't the greatest of news. They were issuing production guidance for 2026 for Kamoa-Kakula that showed that it's going to have lower production actually than 2024. But in the same breath, they were saying that they've had some smelter capacity open up that's going to lead to actually higher sales, even though production is going to go down. And they just commissioned their mine in South Africa, Platreef, which has a slew of precious metals, including PGMs, which we haven't talked about in a while, but platinum and palladium have been doing spectacular as well. And so that stock today, just despite announcing a production cut, I would say, is up 6 or 7% on the day. So that's a bigger company. And then, I mentioned ETFs to you last month, like PICK, as I was taking a little bit of gold profits off the table and then I was putting them in ETFs like that. So copper, again, is the most critical metal there is. There's a lot to like about it. And we see, going back to the majors and the mergers and acquisitions, what just happened with Teck and Anglo and BHP, which I just mentioned. And there's clearly a willingness of these major companies to replenish their coffers and bring in production that's expected to come online in the near term. And near term in the mining space can be a relative term, but over the next 2 to 5 years, let's say. So yeah, that's sort of how I do it. And then there's, even smaller producers that I don't know if I've mentioned to you or not, like Aero Copper in Brazil, for example, that's been doing wonderful as well. So a lot to like in the copper space. And I don't know if $5 is enough to incite or incent new production to come online, but it's certainly enough to generate headlines and make people steal copper, by the way, which has been back in the news all the time. And maybe you should go out there and own some copper stocks. I've written that editorial a number of times over my career is you could just own copper stocks so you don't have to be out there stealing copper from people's wires.
A great point, Nick. You could be stealing value by riding the copper stocks higher versus stealing people's copper personally. So, a great point there on all the different sectors: copper, lithium, gold, silver, even weaving in some of the energy space with uranium and oil and gas. So, a nice, well rounded discussion as always. And again, if people listening in want to get more of Nick's thoughts, definitely click on the link below. It takes you over to Digest Publishing, and you can see their whole suite of offerings. They cover a lot of different sectors, including the private placement business that he mentioned. So, Nick, we always appreciate having you on the KE Report. And as always, looking forward to our next conversation.
Thanks, guys.